prepare the consolidated balance sheet as on 31st March 2019 of a group of companies comprising of P Limited, S Limited and SS Limited. Their balance sheets on that date are given below. So there are three companies, P Limited, S Limited and SS. Figures are in lakhs of rupees. They are saying property, plant and equipment. Investment is given. If you will see that carefully, you will realize that P Limited has invested in S Limited, and this investment, right, it is in the balance sheet of S Limited. That means S Limited has purchased shares of SS Limited. So P has a holding in S Limited and S has a holding in SS Limited. Okay. Inventories, trade receivables, biz receivables, cash in hand and at bank. Equity and liabilities, they have given us the equity share capital. Shares are of 10 rupees each. In other equity, we have reserves and retained earnings, trade payables, bills payable, and then they have given us P Limited and SS Limited. So bills payable are against the parent company, the bills payable are against the other subsidiary company. Okay. So the parent and the subsidiary must have done transactions with each other, and then they are having some outstanding balances. They are saying the following additional information is available. Okay. P Limited holds 80% shares in S Limited and S Limited holds 75% shares in SS Limited. Their holdings were acquired on 30th September 2018. That means 30th September 2018 is the acquisition date. Right. So this is the date on which we are acquiring the shares. If I just check with the balance sheet date, the balance sheet is on 31st March 2019. So the year must have started on 1st April 2018. So during the year, after 6 months of the completion of the current year, you have purchased the shares. Remember, whatever are the profits and reserves up to 30th September 2018 will be pre-acquisition, and after 30th September 2018 will be post-acquisition. Okay. The business activities of all the companies are not seasonal in nature, and therefore it can be assumed that profits are earned uniformly throughout the year. Okay. On 1st April 2018, the following balances stood in the books of S Limited and SS Limited. So at the beginning of the year, they have given us the balance in the reserves and the balance in the retained earnings. Information 4, they are saying rupees 10 lakhs included in the inventory figure of S Limited is inventory which has been purchased from SS Limited at a cost plus 25%. So there seems to be a transaction between S Limited and SS Limited. SS Limited has sold the goods. See, they are saying it is inventory which has been purchased from SS. If you are saying purchased from SS, that means SS has made the sale. So when you do pre and post acquisition analysis of SS, at that time you should take care of the unrealized profit. And in the last information, they say the parent company has quoted an the parent company has adopted an accounting policy to measure the non-controlling interest at fair value. Fair value, then they are clarifying it is nothing but the quoted market price. Applying the Ind AS 103. Assume market prices of S Limited and S Limited are the same as the respective face values. See, when we are valuing the non-controlling interest, we have the fair value approach, or we are having the share in the or the proportionate share in the net assets, right? These are the two approaches which are available. Towards the end, they are clarifying that the parent has decided to apply the approach of valuing the non-controlling interest on fair value basis. But then I require the fair value. They say fair value is equal to the face value of the share. So if I just look into the balance sheet, equity share capital, they are saying is rupees 10 per share. So 10 will be considered as the quoted market price, and on the basis of that, the fair valuation of the non-controlling interest on the date of acquisition shall be carried out. Yes, as far as additional information is there, as far as the adjustments are there, it's a pretty simple question. But what really is remarkable about the question is its holding structure. See, the holding structure which they have given in this question, it is popularly known as a chain holding structure. You are having a company P Limited, right? Interpret this information. 1, P Limited has 80% shares in S Limited. And then they say S Limited has 75% shares in SS Limited. This is the holding structure which they have given, right? This holding structure is what is popularly known as a chain holding structure, where you have a subsidiary and then the subsidiary has a sub-subsidiary. The names, I mean, the alphabets are also very notable. If you will see, P Limited we understand as the parent, S Limited we understand as the subsidiary, and SS Limited, it is a subsidiary of subsidiary. Subsidiary of subsidiary is also popularly known as a sub-subsidiary, right? You can even call SS Limited as a sub-subsidiary. By sub-subsidiary we mean a subsidiary of the subsidiary. So this is yet another way in which we can refer to SS Limited. So in a chain holding structure, how exactly the workings will be carried out? As far as pre and post acquisition analysis is considered, as far as the reserves, the increase in the reserves and profits is considered, all that will be done on regular lines. Things will really change when you will do the calculation of cost of control and the calculation of the non-controlling interest. At that time, the chain holding structure will come into play, and accordingly we'll have to work out the non-controlling interest. Accordingly we'll have to work out the goodwill or maybe the gain on bargain purchase. So let us see how the initial working notes can be prepared. Yes. We say working notes. The first one, increase in profits and reserves in 2018-19 of the subsidiaries. If we check with the balance sheet, they have given us reserves and the retained earnings. We have S Limited. We'll say reserves and then retained earnings. We have SS Limited. Here also we say reserves and the retained earnings. We'll start with the closing balance. So we say balance on 31st March 2019. These are the closing balances which are given for the reserves and the retained earnings. 150, for the other company it is 80 and 60. We haven't come across any point of dividend or anything, so from the closing balance we will deduct the opening balance. Balance on 1st April 2018. It is there in additional information 3, 80 and 20. 80 and 20. And for SS Limited, it is 60 and 30. Take a difference, 20 here, 30 here. Here also 20 and 30. Figures are of course in lakhs of rupees. You can clarify at the top if you wish. Rupees in lakhs, right? It will remain common for all of our workings. Time for the pre and post acquisition analysis now. Our second working note. Pre and post acquisition analysis. Pre and post acquisition analysis of the subsidiaries. Okay. Prepare a format for the same. Our acquisition date is 30th September 2018. Profits and reserves on 30th September 2018 shall be pre-acquisition. After that, post-acquisition. We will first do it for S Limited. Yes, we start with equity share capital. So we say here equity share capital. Our purpose of doing pre and post acquisition analysis is also to work out the net assets that were existing on the acquisition date, because the net assets on the acquisition date will ultimately help us in working out the cost of control. So that is the reason we do take the equity share capital. As far as S Limited is considered, the equity share capital is turning out to be 400. So we say here 400. Next we say reserves. Okay. Now on 1st April 2018, yes, the additional information, here it is. On 1st April 2018, the reserves are 80, isn't it? The reserves are 80, but we do not want reserves on 1st April 2018. We want reserves on 30th September 18. So during the year, the reserves have increased by 20. So this reserves of increase, right here it is. This reserves of S Limited has increased by 20. This 20 increase has happened during the entire year, and they have themselves given that consider that the profit has been earned uniformly throughout the year. So if 20 lakhs was transferred to the reserves during the entire year, in the first 6 months, 10 lakhs must have been transferred. So accordingly, we will pick up the figures over here. Reserves, we will say $80 is already given, plus 20 into 6 by 12. Similarly, here it will be 20 into 6 by 12. So I get here 90 and here 10. Then we have retained earnings. Retained earnings, when we acquired the shares, the retained when at the beginning of the year, the retained earnings was 20. So I say here 20 plus the increase in the retained earnings during the year has been 30. First 6 months will be up to 30th September. So I'll multiply that by 6 by 12. While here it will be 30 into 6 by 12. This is turning out to be 35. This is turning out to be 15. Okay. 490 and 35. I take a total 525. This is 10. This is 15. We will repeat this now for SS Limited. Again, equity share capital. Check with the question. Equity share capital is 320. 320. Reserves. When we acquired the shares, we want the reserve balance on that day. They have given us the opening balance of 60. So on 1st April 2018, it is 60. However, I want to know what will be the balance on 30th September 2018. So during these 6 months, there shall be increase in the reserves. The increase in the reserves during the 6 months has been 20, isn't it? This 20 now. This 20 has to be now considered. And then in retained earnings, this 30 has to be considered. Your reserves the balance which is there is 60 plus 20 into 6 by 12. Here also 20 into 6 by 12. This will be 70. This will be 10. Retained earnings. Retained earnings. Retained earnings balance on 1st April is 30. Increase during the year is also 30. $45 and 15. However, there is one intercompany transaction here that we have to consider. Information 4. Rupees 10 lakhs included in the inventory figure of S Limited is inventory which has been purchased from SS Limited at cost plus 25%. So there is unrealized profit, and this unrealized profit has to be eliminated. They are saying it is cost plus 25%. So if the cost is 100, profit is 25%, so that will turn out to be 25. In other words, your selling price is 125. So applying the rule of proportion, it is working something in this way. Selling price and the profit. Okay. Selling price is 125, then profit is 25, while our selling price is 10 lakhs of rupees. So if it is 10, then how much is the profit? So I take 10 and multiply that by 25 by 125. My profit is turning out to be 2 lakhs. This profit is still lying in the inventory. If the goods are still if the goods are still held in stock, then the profit will become unrealized. Who has booked the profit? SS Limited has booked the profit. So from the pre and post acquisition analysis of SS, we should eliminate this profit. However, the exact date on which the transaction has occurred is not given. We know that our acquisition date is 30th September 2018. If this transaction has happened before 30th September 2018, then this 2 lakhs of unrealized profit is lying in the pre-acquisition profits. And if this transaction has occurred on 30th September 2018 or later, then the unrealized profit is lying in the post-acquisition profits. If you see information 4, they have not really clarified that when exactly this transaction has occurred. Has this transaction occurred before we acquired the shares, or has this transaction occurred after we acquired the shares? So we will have to make an assumption. We will assume, and let me be very clear, we will assume that this transaction has occurred towards the end of the year. That is our way of thinking. It's very much natural that these companies would be doing transactions with each other. The parent might be selling to the subsidiary, or the subsidiary is selling to another subsidiary. They are doing transactions with each other, and then later on the company which has purchased it might be consuming it or selling it to the third party. If this transaction has occurred towards the end of the year, then maybe there is not sufficient time left for you to consume or sell the goods to a third party. And that is the reason the goods are still lying in the inventory. For example, if you have done this transaction in the last month of March, last week of March, if this transaction has occurred in the last week of March, then there is not sufficient time left for S Limited to dispose of these goods, to sell these goods to a third party, and hence it has remained in the stock. But the moment you say that this transaction has occurred towards the end of the year, that means you are trying to say that the transaction has occurred after our acquisition date of 30th September 2018. And if you say it has occurred after the acquisition date, then it is going to be eliminated. The unrealized profit is going to be eliminated from the post-acquisition profits. So we will eliminate 2 lakhs from post-acquisition profits. We say unrealized profit in sale of goods. You can show your calculation if you wish. 10 into 25 by 125. There's an unrealized profit of 2 lakhs. Remove it. These are the totals this time for SS Limited. Let me put it in a way that we can have the figures of the S as well as SS, the totals I mean. Trying to do cost of control. We will like to work out the goodwill or the gain on bargain purchase. Now, when you are calculating the cost of control, you will have to give due importance to the holding structure. On the side, I am again plotting the holding structure. P Limited has 80% shares in S and S has 75% shares in SS, right? This is the holding structure which they have given. I want to work out the cost of control over here. P has direct control over S Limited, right? But P does not have direct control on SS Limited. P is controlling SS indirectly through its subsidiary. So we will have to work out that what is this indirect control, many a times also known as the effective control. I have purchased 80% shares of S Limited. So S Limited is directly controlled by me. Then this company S Limited is buying 75% shares, let's say, of your company. So SS is directly controlling your, S is directly controlling your company, but I am not directly controlling SS. I am indirectly controlling SS through my subsidiary. So what we are suggesting here is we say direct control of S in SS, okay, is 75%. Direct control of P in S is 80%. So we want to know what is the indirect control of P in SS. I am directly controlling S, S is directly controlling SS. But I am seeing this from the viewpoint of the parent company. Parent company is P Limited. So P Limited wants to know what is its effective control, indirect control in the subsidiary of the subsidiary. So this you will get in this way. We will say it is 75 into 80%. Okay, 75 into 80%. That is turning out to be 60%. It is turning out to be 60%. P is effectively controlling SS to the extent of 60%. Now we know that the total percent should be 100, isn't it? The total percent should be 100. So 40% is the balancing figure. 40% will be considered to be the non-controlling interest. I have effective 60% control over SS. If you say you have effective 60% control over SS, then the remaining shares naturally has been purchased. The remaining shares are naturally been owned by the non-controlling shareholders. So I suggest over here 40% is the non-controlling interest, right? We get the non-controlling interest. We are getting this non-controlling interest as a balancing figure, 40%. Please go through it again. Just let it sink. Just let it sink. Yes. Direct control of S in SS 75%. Direct control of P in S is 80%. Indirect control of P in SS hence is turning out to be 60%. And the non-controlling interest is turning out to be 40% as a balancing figure. Now, of course, you may not really like a balancing figure over here. You know, we are saying non-controlling interest is balancing figure. You may feel that how can I do such an important exercise of consolidation based on a balancing figure? Then we can also go for a verification. Okay, we can go for a verification over here. We are doing this verification for the non-controlling interest. We are saying right now 40%. But we are saying 40% as a balancing figure. Okay. Now, the way we are interpreting it again, just see. S is having 75% in SS. Okay. S is having 75% in SS. So I can say this is direct. I'm writing in short NCI. We said direct non-controlling interest of S in SS. Okay. It will be 100 minus 75%. So that turns out to be 25%. You agree with that? S is having, as you can see on the side, S is having 75% in SS. That means the non-controlling interest is 25% in SS. So I'm saying it is 25%. This is the direct NCI. Then we have an indirect NCI. We say indirect non-controlling interest of P in SS. Okay, of P in SS. Just see here. P has, understand, P has 80% in S. That means 20% is the NCI over here. This 20% I apply to this 75%. So I say this is 75% into 20%. Okay. 75 into 20%, that is turning out to be 15%. If I take a total, I get 40%. Just see, 40% here and 40% over here. We are able to verify the balancing figure of the non-controlling interest of 40% over here. It's very much like the way we did it over here. See, if still it is unclear, then see, this is what we have done. Understand, P has we are saying P has 80% in S and S has 75% in SS. So this 80 and 75%, we multiplied the two, right? We multiplied the two. So I did 75. What I did is 75% into 80%, and that's how I got 60%. That same rationale can now also be applied over here. If P has 80%, then there are non-controlling shareholders here also. They have 20%. They have 20% in S, and then S has 75% in SS. So just as I did it over here, I say now over here that it is 75% into 20%, and that is how we get the 15%. Okay, S is already having 75%, so here the non-controlling interest is 25%, and the total is turning out to be 40%. I hope you are comfortable with what I am trying to suggest. So basically what we realize over here is that P is having an effective control of 60% in SS, and the non-controlling interest in SS will be 40%. This will help us in now working out the cost of control. I want to know what is the goodwill or the bargain purchase gain. We start with fair value of consideration on 30th September 18. Fair value of consideration on 30th September 2018. Check with the question. P Limited has purchased the shares of SS for 340. So I apply 340 over here. And S has purchased the shares of SS for 280. But be careful here. We will not put 280 over here. We will say 280 and multiply this by 80%. Okay, 280 and multiply that by 80%. I'll just explain you in a moment why we are doing this. So we are getting 224. You will not directly place 280. You will take 280 and multiply that by 80%. We have been constantly saying this. This is what we are planning to do. See, here it is. 75 into 80%, because our effective control is 60%. P Limited's holding, effective holding in SS is 60%. So when you are doing the calculation of the cost of control, we require the effective cost of buying 60% shares. Please get it. We want the effective cost of buying 60% shares. So try to ask yourself, what is 280? Tell me, what is 280? 280 is lying in the balance sheet. What is 280? 280 is cost of buying 75% shares in SS. Okay. 280 is the cost of buying 75% shares in SS. But when I am calculating the cost of control for SS, we are seeing it from the viewpoint of the parent company. Parent does not purchase 75% shares in SS. Parent's holding in SS is not 75%. Parent's holding in SS is 60%. But how will I get this 60%? 75% is to be multiplied by 80%. Then I will get 60%. So I want to know that what is the effective cost of buying 60% shares. So this 280, it is the cost of buying 75% shares. Please understand. 280 is cost for 75% shares, isn't it? So if I multiply this by 80%, check here, 75 into 80%, isn't it? When I multiply this by 80%, I am getting 224. What is 224? 224 will be cost for 60% shares because my holding in SS is 60%. That is the reason I am multiplying it by 80%. I hope you are getting the logic over here. Check here, 280 is there, right? 280, 75% shares. So I have purchased 75% shares. It has costed me 280. But I am doing this, I am preparing this working notes from the viewpoint of P Limited because ultimately I have to prepare the consolidated balance sheet of the main parent, which is P Limited. So P Limited's effective holding in SS is 60%. So this is the cost of buying 75% shares. I want to know what will be the cost of 60% shares. This is what I want to know. I know one thing, that if 75% will be multiplied by 80%, I will get 60%. So I take this 280 and this 280 I multiply by 80%. I get 224 and this 224 is nothing but the cost of, the effective cost of 60% shares, right? So this is the reason that we have done it in this particular way. So this was the fair value of the consideration. To this, we should now add the non-controlling interest. We say value of non-controlling interest, value of non-controlling interest on 30th September 18. This value of non-controlling interest on 30th September 18, we have to do it on fair value basis. That's how the question has been designed this time. The last information actually. In last information, they are saying that the parent company has adopted an accounting policy to measure the non-controlling interest at fair value. Then they say fair value is nothing but the quoted market price, applying Ind AS 103. But later on they are saying that assume the market prices of S Limited and SS Limited to be same as the face value. Face value is nothing but rupees 10. So basically they are referring to the share capital. The share capital itself will be turning out to be the total fair value this time. Okay, so here it is, the equity and the liabilities. It is 400 over here. We have purchased 80% shares, so 20% is the NCI. So I say here 400 into 20%. So at fair value basis, it is turning out to be 80. And what is the share capital for the other company? The share capital for the other company is 320. So here I will consider 320 and be very much careful here. We'll say 320. The non-controlling interest here is 40%. Okay. I get 128. So 340 plus 80, 420, 224 plus 128, 352, less value of identifiable net assets on 30th September 18. This I will get from the pre and post acquisition analysis, 525 and 435. 525 and 435. Okay. So 420 minus 525, it is negative, but write it as positive, 105. This is 352 minus 435, negative 83. It is negative, that means this is gain on bargain purchase. Gain on bargain purchase. I'll take a total of the two. Total of the two is turning out to be 188. Right, this bargain purchase gain, it will be transferred to capital reserve. When we will prepare the consolidated balance sheet, at that time this 188 will be transferred to capital reserve. It will be recognized in OCI, other comprehensive income. We will be making it part of the capital reserve. I hope you are okay with this particular working to get the goodwill or the gain on bargain purchase. This time we are getting gain on bargain purchase. It is the calculations of SS Limited which are really important. Your effective control in SS is only 60%. That is the reason 40% is the NCI. So we took NCI as 40%. And I require the effective cost of buying 60% shares. They have given me the cost of buying 75% shares. So that cost I'm multiplying by 80%. I get the cost of 60% shares. And as our final working, yes, I will like to know what is the non-controlling interest. Yes. Non-controlling interest. As on 30th September 2018, we get it from the earlier working. $80 and $128. After 30th September 2018, I'll require the change 10 and 15 over here, 10 and 15. Into 20%. And for the other company, it is 10 and 13. 10 and 13. Here it will be into 40%. Okay, the non-controlling interest is 40%. Fine. So let me calculate it. It's 5 over here. 85. $9.2. I get 137.2. However, it's still not the end of the working, but this is the figures that we are getting on the acquisition date, and after the acquisition date, what is the share that is belonging to the non-controlling interest. Now, if you check with the balance sheet, here it is. This 280, I want you to concentrate on that. See, this 340 is entirely taken. But in S Limited, you have a figure of 280. Now, when you calculated the cost of control, okay, when you calculated the cost of control, you have taken only its 80%. Right, this 280 was multiplied by 80% and it turned out to be 224. So out of 280, 224 has been taken care of. But the balance figure also has to be taken care of, isn't it? The balance figure is turning out to be 56%. The balance is 20%, which is turning out to be 56. In your balance sheet of S Limited, you are saying that the cost of buying the shares in SS is 280. I have already cancelled 80% of it. So 224 has been taken care of in the cost of control. But what about the remaining 20%? The remaining 20% is still lying in my book. So this remaining 20% also needs to be considered. This remaining 20% belongs to the non-controlling interest. Remember, it belongs to the non-controlling interest, this 20%, which is nothing but 56. So this 56 should be adjusted with the share that the non-controlling shareholders are getting in S Limited. I'll say here, cost of investment in SS Limited. We can even say share in, okay, share in cost of investment in SS Limited. It is 280 into 20%, which is turning out to be 56. You have to put this as negative over here. So I get this as 29. This is 137.2. 29 plus 137.2. The total non-controlling interest is 166.2. If you want share in the profits of SS, our line of argument is in this way. If you want share in the profits of SS, then you also have to bear the cost of the shares in SS. You cannot just simply take away the share in profits without bearing the cost for getting that share in the profits. This is the reason the share in the cost of investment in SS will be adjusted against the non-controlling shareholders. Okay, right from the very beginning you were saying that as a non-controlling interest, my interest in SS is 40%. You have taken away 40% of the profits also. If you are taking away 40% of the profits, then it is time for you to bear the cost also, right? So that is the reason that we are considering over here what will be the share in the cost of investment in SS Limited. So eventually we are realizing that the non-controlling interest is turning out to be 166.2. We are through with the workings. We can now prepare the consolidated balance sheet. Yeah, let's prepare the consolidated balance sheet. The consolidated balance sheet will be prepared of P Limited as on 31st March 2019. I'll just clear up the balance sheet so that we can pick up the figures. Consolidated balance sheet. of P Limited as on 31st March 2019. Prepare the format. We'll start with the assets. In that, the non-current assets. Yes. Check with the question. You have property, plant and equipment as the first one. Property, plant and equipment. There is no adjustment for it. So just add these three figures. $980. Investment 340 cancelled. Investment 280 cancelled. Then we are having inventories. There is a point of unrealized profit over there, isn't it? Only one item is there. We say next. Current assets. Under current assets, we say inventories. Note 1. Yeah, then we have been given trade receivables, and then they've given you bills receivable. Now, bills receivable, there is an adjustment relating to it. If you see equity and liabilities, in equity and liabilities, they've given you the bills payable. It is very natural that if one company is showing it as bills payable against the parent or bills payable against the subsidiary, then naturally that other company will be showing it parallelly as a bills receivable. So there is an adjustment as far as bills receivable is considered. Trade receivables, we can take them as they are. So let's take a total and put that total figure in our balance sheet. So we say trade receivables. Carry out the line by line addition here. 260, 100 and 220, 580. And then we have bills receivables. We'll prepare a note for the same. And then we have cash in hand and at bank. So cash and cash equivalents. Okay. Cash and cash equivalents. Do line by line addition here. This 228, 40 and 40. So 228 plus 80 actually. 308. Total. Leave it blank. Time for equity and liabilities. Under that equity, under that we say equity share capital. other equity, non-controlling interest. Yes. Equity share capital and other equity you will get from the SOCE. Non-controlling interest from your workings 166.2. 166.2. Liabilities. Under that first, non-current liabilities. We have trade payables and bills payable, so there aren't any non-current liabilities. We say 2 current liabilities. We do have trade payables over here. So under this we say trade payables. Carry out a line by line addition. 470 plus 230 plus 180, 880. And then we have bills payables. We'll prepare a note for it because there is an adjustment for the same. No other item is there. We say total, we leave it blank. We don't have the total right now. Okay, if you're still writing. Time to prepare statement of changes in equity. We have results, we have retained earnings, and this time we had gain on bargain purchase, which will be transferred to capital reserve. So a column for capital reserve, and then the total. Okay. That's your format. Statement of changes in equity. Oh, sorry, we were first supposed to show, just a second. We were supposed to show equity share capital, just a second. We're first supposed to show A, equity share capital. This was a part of other equity. Say equity share capital. Balance at the beginning. Change during the period. Balance at the end. The equity share capital of the parent is 600. Posted in the balance sheet against equity share capital 600. And then part B will be other equity. We say here balance of P Limited as given. Check with the balance sheet. 180 and 160. 180 and 160. $340. Then we say share from subsidiaries. Share from subsidiaries. S Limited. Here it is, this 10 and this 15, right? 10 and 15. Our share is 80%. Eight, 12 and 20. Right, 8, 12 and 20. Then from SS Limited. SS Limited. You have this 10 and 13. 10 and 13. 10, but be careful here, 60%. Here, 60%. 6. 7.8. 13.8. Gain on bargain purchase. Gain on bargain purchase. We have prepared one capital reserve column. We have to show it over there. Here it is, 188. Okay, 188. Nothing else is really there, so we take a total. $188 and 6, 194, 160, 12 and 7.8, 179.8, 188. $561.8. $561.8. Posted in your balance sheet, 561.8, other equity. Time to prepare the accompanying notes now. See accompanying notes. Note 1 is for inventories. We say as given. Here it is, 220, 70 and 50. 340. Less unrealized profit. Okay, the inventory includes the unrealized profit of 2. 338. Right, 338. Posted in the balance sheet. $338. Now for bills receivables. As given. Line by line addition of bills receivable 72 and 30, 102. Less mutual obligation. Less mutual obligation. If you check with the liabilities, you have bills payable. See, bills payable 70 is there and bills payable 30 is there. That means 100 lakhs of bills payable is within the group itself. Within the group means mutual obligation. So I will say here 100. We will clarify here in brackets. 70 plus 30 from bills payable, right? Just for your understanding, so that when you sit down for revision, you remember how you got that 100 figure. So bills receivable are 2 lakhs. Posted in the balance sheet 2. We are ready with the balance sheet side. We can take a total and place that total in our balance sheet. It's 2208 balance sheet total. 2208. We still need a note for the bills payable now. Bills payable as given. We already know the figures, 100, and entire 100 is mutual obligation. Put a blank, take a total. Equity figure is 600. So 600 plus 561.8 plus 166.2 plus 880. 2208. Right. Assets 2208. Here it is, the entire asset side. This is the equity and the liabilities. 2208. That's the end of our consolidated balance.